The 2008 financial crisis permanently erased consumer faith in traditional banking. When institutions like Lehman Brothers collapsed, the industry faced a systemic breach of trust that created the space for an alternative model. Technological advancements and shifting regulations moved into this vacuum, allowing the development of digital financial alternatives. These platforms were built from the ground up, without the weight of legacy infrastructure. Neobanks now capture 30 to 40% of all new banking relationships worldwide. But a paradox appears in the revenue. Despite acquiring half of all new users, these digital-only players account for a mere 5% of total financial services revenue. This gap exists because of a historical strategic flaw. Early digital banks, particularly in the US, prioritized a frictionless user experience over the development of complex financial products like mortgages or business lending. This growth model relied heavily on interchange fees, taking a small percentage of every debit card transaction. While effective for quick user acquisition, it failed to generate the interest income that sustains a traditional bank balance sheet. That approach created a fragile ecosystem. Millions use these slick apps for daily spending, while keeping their primary savings and paychecks at legacy institutions. The window for pure user acquisition is closing. To achieve long-term survival, neobanks are now forced to pivot toward core balance sheet profitability. They must evolve from secondary spending apps into primary banking relationships. This requires a successful cross-sell of lending products and professional wealth management to their existing user base. As neobanks target these primary accounts, regional banks face a direct threat, a steady erosion of market share that could eventually become fatal. Banking infrastructure is undergoing a total transformation. Heavy physical branch networks are being replaced by weightless digital networks, moving at the speed of software. Legacy models carry a massive operational burden. Maintaining thousands of physical locations creates high overhead costs and enforces slow, bureaucratic deployment cycles for every new product update. This matrix illustrates the contrast. Traditional banks rely on physical branches, while neobanks operate digitally for instant signups. They achieve this operational speed through application programming interfaces, or APIs, enabling scalable, modular financial products. However, this speed creates risks. Rapid digital integration creates a larger surface area for identity fraud and sophisticated cyber attacks that can compromise a platform in minutes. High transaction volumes also place a massive strain on underdeveloped AML frameworks. AML stands for anti-money laundering, a set of laws designed to prevent criminals from making illegally obtained funds appear legitimate. Traditional banks utilize their physical presence and established infrastructure as operational buffers. This institutional weight provides a layer of resilience that helps them weather macroeconomic shocks more effectively than a digital startup. While API architecture allows for unprecedented scaling, it often lacks the operational maturity needed to ensure the long-term stability of a global financial institution. Technological superiority is often secondary to the legal environment. Regulation is the ultimate dictator of a neobank's ability to mature into a profitable entity. In 2018, the EU implemented the PSD2 directive, legally mandating open banking by forcing banks to share customer data. Combined with the EU passporting system, this framework let European neobanks scale full-stack operations across international borders with minimal friction. The United States market is far more complex. It is a fractured regulatory landscape overseen by the OCC and the FDIC. The OCC regulates national banks, while the FDIC provides deposit insurance. This lack of a unified charter creates a bottleneck. To function, domestic neobanks are forced to reroute services through established partner banks. This reliance caps product maturity. Because they lack their own charters, many U.S. neobanks cannot issue direct loans, leaving them dependent on the low margins of interchange revenue. Regulatory unification is the deciding factor in bank evolution. Without the ability to hold a charter, a platform remains a spending app rather than a primary bank. Survival for neobanks now depends on a single financial shift. They must transition from transaction fees to generating core interest income. This dashboard tracks the targets for a mature digital bank. Sustainability requires pushing interest-based revenue from an industry low of 30% toward a goal of 80%. The critical metric here is ARPU, or average revenue per user. It measures how effectively a bank sells new products like credit cards or savings plans to current customers. Expanding into lending increases risk. Banks must strictly monitor their loan loss ratio, which measures the percentage of uncollectible loans, acting as an indicator of credit risk management. To maximize ARPU while controlling risk, digital banks are targeting affluent users with tiered subscriptions. These packages consolidate high-yield deposits, stock investments, and credit lines into a single premium relationship. We are also seeing the introduction of non-traditional assets, such as digital gold custody and cryptocurrency trading, to keep users within a single application ecosystem. High user counts are a hollow metric. A neobank is only successful if it can convert those users into borrowing, interest-paying account holders. Traditional regional banks are now adopting the exact operational tactics of their digital competitors to prevent a total loss of market share. They are accelerating their internal momentum. This requires moving away from heavy mechanical processes and toward a high-speed digital drive. This starts with restructuring internal product cycles. Multi-week committee approvals are being replaced by 2-day startup-style development sprints to get new features to market faster. They are also implementing gamification. By using behavioral hooks like deposit streaks, traditional banks are driving the daily app engagement that previously only neobanks enjoyed. Hidden fees are being replaced by transparent, subscription-based monetization. This model bundles all of a user's financial services into a single, predictable monthly fee. Legacy product boundaries are expanding. To stay relevant in a user's daily life, some banks are even offering non-banking tools like travel eSIMs directly inside their mobile applications. AI integration moves from basic customer service chatbots into the core of the operation. This enables rapid product prototyping and advanced fraud monitoring that matches the capabilities of any digital-first competitor. Traditional banks can no longer rely on branch proximity for security. They must weaponize their balance sheet strength with the digital agility of a software company. A market collision is coming. Highly mature foreign neobanks are securing U.S. charters to launch full-stack lending operations and compete directly for primary accounts. In a strategic reversal, some digital-only platforms are now opening physical branch locations to better serve high-net-worth private banking clients. The defining competitive moat in the next decade is not user acquisition. It is the ability to safely manage lending risk at a massive scale. This marks the convergence of two distinct financial models. One is built on rigid physical structures, and the other on fast-moving digital energy. They are weaving together into a single industry standard. The winners will be the neobanks that master regulatory compliance and the legacy banks that master digital execution.